Hello and welcome traders and enthusiasts to session that promises to empower your trading journey and elevate your analytical competency. My name is Ali. I'm head of training and education at Orante Broker, and today we are going to discuss the ways to decode market structure for smart trading. If you remember, in our previous session we had a webinar about the principles of technical analysis on how to understand the market trends in different ways. And today we are going to talk about the uh, more advanced technique, or let's say more practical techniques that will make you able to identify the trends and how to, let's say, encounter them in our trading strategies. Let me start from this point that this webinar has been brought to you by Arante, which is an online broker committed to providing top-tier services and building lasting and trusting relationship with clients and partners. The strategies, insights, and analysis we will explore today, and also in the other webinars that we have, are built upon a rigorous study and market observation. However, they come with no guarantee of future performance, and each investor's diligence, informed decision making, and consideration of personal risk tolerance are paramount. So, because the CFDs are very risky products, so you have to make your own decision uh, after doing all of the necessary research. Okay, uh, let's see what we learned today. Today we are going to talk about the market structure and the ways that technical analysis can help us to define that. In case of supplies and the supply and demand dynamics, and also the identification ways or techniques of key levels like support and resistance levels in the market. And we will learn how to trade with these levels, and how to recognize the different, like a historical key levels, and also the dynamic and static key levels in the market. And then we will go through a different trading strategies together. I hope this webinar helped you also to uh, gain expertise in identifying and interpreting the market trends that would let you trade with confidence in financial markets. So during this session, guys, we will have interactive question and answers. You can just write your questions as soon as they arise, and I will try to answer them if I know the answer. Don't hesitate to ask your question regarding your strategies or the topics we are going to discuss today. Again, let me welcome you to the first step of our journey into the world of technical analysis. As we embark on this exploration, it's crucial to understand what technical analysis is. We explained it in great details in our previous session. But here is the very brief, let's say, explanation about why we need to use technical analysis and how we use it to have a better trading journey. Let's start with the fundamentals. First, we have the price charts. These charts are the canvas on which the market paints its story. Whether it's a simple line chart showing closing prices or a more detailed candlestick chart revealing the open, high, low, and close, each chart offers a unique perspective on the market movements. But it's not just about recognizing patterns in these charts, it's about understanding what these patterns signify. And an upward trend line, for example, tells us the optimism is driving prices higher. Conversely, a downward trend signals that pessimism is taking hold. Now, think of market trends as a path. Let me just bring up my MT4, then I can show you in a better form. I hope you can see my MetaTrader 4 right now. Let me also check here. Okay, perfect. Okay, now think of market trend as path. This path shows us where the market has been, and more importantly, can give us clues about where it might go next. So this is our mission, guys, here. Identifying these trends is a crucial skill, and it's about all about identifying the direction of the market, and it's moving upward, downward, or sideways, as we discussed previously. That we have three different direction in the market. So, and then we delve into the realm of trading indicators. For example, here you see I have a moving averages in different time frames: 200 moving average, 150 moving average, and you see how we can get trading signals from these moving averages by price crossing over these moving averages. So we will get into more details for sure. By the end of this session, you will have a solid foundation in technical analysis, and you will be equipped not just with knowledge, but with a new lens to view the market, a lens that brings clarity to complexity. For example, what you can see here is the market is moving in different path and trends. So our mission today is to find a ways to identify the market trend, aiming to predict the price for the next level for the foreseeable future, let's say. And in that case, we will use the sentiment analysis. We need to understand the different time frames and how they can impact the reliability of our trend lines, and also not in forex trading, but let's say for a stock trading, we need a confirmation from different aspects like a volume analysis or something like that. So imagine you are about to embark on a journey through a vast and complex city. That's the financial market. Just like understanding a city's layout is crucial for navigating, grasping the market structure is essential for navigating the financial market as well. So let's decode this structure together to see what does it mean, market structure. We look at the key trading levels. First of all, market structure is the way a market is organized, encompassing the system's rules and procedures. It's essential to be familiar with it, because we really need to know the reason behind the moves at the first glance, but not too deep, because we're going to use the technical analysis to capitalize on the market movement, but we really need to know how the market is organized. So first we look at the key trading levels. Think of it as a main streets and landmarks of our city in the market. These are the support and resistance levels, guiding us where to enter and exit trades, much like deciding where to stop and explore in a city. Okay, now consider the market participants as another key factor for market structure, and these are the city's inhabitants, from the locals, the retail traders, to the big corporations, the institutional investors, and the market makers, akin to city planners. Each plays a unique role influencing the market's price movements, just as people shape a city character. And next, we navigate through the market phases. Our city evolves through different stages, from quiet neighborhoods, accumulation phase, to bustling markets, markup, and perhaps to a redeveloping area, distribution phase, We call it distribution phase in the market. And finally, to quieter suburbs like a markdown, when you see the end of a trend. Similarly, markets move through these phases, and recognizing them helps us anticipate potential market turns for sure. And then understanding liquidity and volatility is like knowing the city's traffic patterns. Liquidity tells us how easy it is to navigate our trades, and volatility indicates the speed of movement in the market. Both are crucial for creating effective trading strategies, just as understanding traffic is vital for efficient city travel. Okay, and then a regulatory framework is akin to the laws and regulations that govern a city. In trading, it's about knowing the rules, ensuring compliance, and managing risks. It's our guide to staying on the right path of the market. And then technological impact, and this is something that we are hearing about the new developments every day in the side of the technology. So it's really crucial to be up to date on markets, and it's similar to technology's influence on city life. Today's markets are shaped by algorithmic and high frequency trading, demanding we stay abreast of these changes to understand the modern market dynamics. And finally, global connectivity. In an interconnected world, events in one market can impact others. Just as happening in one part of the world can affect a global city, our market analysis must be comprehensive, considering these global influences. As we explore this financial city, understanding its crucial is key, and it helps us navigate the market with confidence, making informed decisions on our trading journey. Okay, let's move to the next slide. It's going to bring us to the core of our discussion today, the market structure overview and the importance of it. Let us start with price discovery. This is the heart of any financial market. This is the process by which the market determines the price of an asset. But this isn't just about buyers and sellers shouting out prices. The complex dance influenced by various factors, the number of participants, the amount of information available, the level of excuse me, the level of competition, and even the regulatory environment. Each of these factors shapes the way prices are formed. So understanding this process is crucial because it helps us gauge whether an asset is undervalued, overvalued, or just right. So then we need to be aware about trading strategy. Each market structure demands a unique approach. In a highly liquid market, for example, strategies might focus on speed and efficiency. In less liquid market, it might be more about identifying and capturing larger price movement. The key is to tailor your strategy to fit the market you're trading. It's not a one-size-fits-all scenario. By understanding the market structure, you can align your strategies to be more effective and in tune with market dynamics. For example, if we return back to our MT4, what you can see here, this is a chart of USD CAD in 5 minutes time frame. So you can see if I want to just follow the trend, I might be on a 5 minute time frame, I might be shocked by this unexpected huge move to the downside. But so in that case, if I want to face the market fluctuations in the very lower time frame, I have to adopt my strategy, my trading strategy to this unique environment. But if, for example, I move to a higher time frame, you see, and there is not much in fluctuation in the price right now. So in that case, I can just stay with the trend or try to get a signal from a lagging indicators like the MACD somehow. Or also a moving averages. And it can also be through about the other trading instruments that we usually trade. For example, if you want to trade USD JPY, if you want to compare the different fluctuations of different market, you can use the average true range or ATR indicator. Let me just find it here. Yes, average true range under the oscillators. Tab in your navigator window, you can find it and you can apply it to the average of 14 previous candlesticks. And in that case, for example, you can see the ATR here has the value of 0.24 pips for USD JPY, but if I use, for example, AUD USD, if I apply AUD USD on the chart, so you see the ATR is much more difference, it's just about the 11 points. So it's half the way of what USD JPY is moving. So in that case, you can measure the fluctuation of the market and you can understand that there might be a need to adopt your trading strategy, your stop loss and take profit levels based on the shape of the market and the level of the liquidity and fluctuation in the price as well. So it was just an, let's say, the example. So let's move on. Lastly, we delve into risk management. This is an aspect that cannot be overstated. We had a comprehensive webinar about the risk management. The structure of the market can significantly impact the risks you face as a trader. For instance, in a market with low liquidity, you might face higher slippage risk. In a highly volatile market, your risk management strategy might focus on tighter stop losses or more conservative position sizing. Understanding the market structure allows you to anticipate and manage this risk more effectively. Again, if we just turn back to the MT4, you see here, based on the different types of instrument. For example, here you see on around MT4, we have the major currency pairs in a light blue. By the way, if, for example, I move to some exotic pairs, like here I see, you can see the spread is totally different, wider, so I need to apply a different risk management tools, or I need to tailor my strategy if I want to trade on a different asset classes. For example, if we look at gold, you see the fluctuation gold even on a 1 hour time frame is so high right here. So it's really recommended to just enter into this market on a lower level of position sizing, so you can decrease the level of your risk, the percentage of your risk when you want to enter the very risky markets like gold or let's say the indices, less than of those trading on the major currencies. So this is the things that you have to consider before you open your trade on in a different asset classes. So in summary, this slide is about understanding DNA of the market, and it's about delving into the mechanics of how prices are set, how to align your trading strategies with the market environment, and how to manage the inherent a risk that's come with different market structures. Now the things are getting more exciting as we progress to the next slide. We delve into the fundamental forces that shape any market. Just a second, sorry. Excuse me. Yeah, I was saying the dynamics of supply and demand. These two forces are the yin and yang of the financial markets, constantly in flux and directly impacting everything from price levels to market liquidity and trends. Because we aim to identify the key levels in the price trends. So first, we really need to comprehend the dynamics of supply and demand in the market. So let's start with price levels. The interplay between supply and demand is what ultimately sets the price of an asset. When demand exceeds supply, prices tend to rise. Conversely, when supply overshadows demand, prices usually fall. So this is the main, or let's say the basic rule behind all price movements. Here you see the prices are actually we see a downtrend, or prices uh, are falling, and here you see an uptrend when the demand exceeds supply, and this downtrend usually happens uh, when we see the supply exceeds demand. Next factor is market liquidity, and this is about how easily you can buy or sell an asset without causing a significant price movement. In a market where supply and demand are closely balanced, trading is typically more fluid, and assets can be traded quickly and with less price slippage. Conversely, in markets where this balance is skewed, liquidity can be lower, making trading more challenging. So understanding this aspect of market structure is crucial for strategy formulation, particularly in terms of trade execution and risk management. For example, if you are a scalper, it's better to look for those asset classes like major currencies that usually come with a lower spread, and they have a more liquidity. And also you need to plan to let's say apply your trading strategy for scalping on these asset classes when you have the most liquidity in the market, like market overlaps in the morning and in the afternoon, when you have the overlap between the Asian session and Europe session, and when you have the overlap between US session and European sessions. So in that case, you will be able to minimize the risk and also the minimize of your trading cost. So that would be the way to consider the market liquidity when it comes to trade and assets. So finally, we'll look at market trends. Supply and demand are not static. It's very important, guys, that they ebb and flow over time, influenced by, let's say, the uh, various of factors, from economic indicators to geopolitical events. For example, this morning you saw just uh, some comments from the Jerome Powell, just impacts on the US dollar in a very sharp way, and we see a huge fluctuation in the market in terms of the dollar depreciation somehow that gave a room to many rival currencies to change the trend in a short term, in a 15-minute time frame, for example, against the US dollar. So it's really important to understand that the market trends are really dynamic, and these long-term supply and demand trends can profoundly shape the direction of the market, but not in a straight line, but in a zigzag pattern that we will see. I showed you in our previous webinar how the trends usually get shape in the market. So recognizing these trends allows us to align our trading strategies with the broader market trajectory, but be it bullish, bearish, or range bound. As you see here, for example, based on our knowledge from the previous webinar, right now we know that this is a range market, as we can't, let's say, recognize the consecutive higher or lower tops and bottoms in the market. So, but if we, for example, move to a higher time frame, we see the broader picture of the market is totally trendy, because based on what we discussed in our previous webinar, right now, you know, the shape of these higher tops and higher bottoms here means the market is in an uptrend right now, until we are seeing the penetration of this important market bottom, that can be a key price level for us to watch to understand the next move of the market. And this is what we are going to discuss right now. So in essence, it's all about understanding the bedrock upon which markets are built. For example, when you see the demand is rising in the market, it means it can move the price to the upside. And then when we get to a particular point, we might see that the buyers going to retreat from the market, or let's say sellers take the lead, and then we see the prices are falling right now. But what about this level here? The level that we are going to discuss about it shortly. This is a key level right now, and I'm going to show you how. So this knowledge is key to developing a nuanced understanding of the market and to making informed decisions. Okay, moving to the next slide, we focus on the concepts pivotal to technical analysis, understanding support and resistance. These are not just lines on a chart, they represent key psychological levels where the market consistently shows hesitation or reversal. They are the threshold of supply and demand. Now that you know the reasons behind supply and demand, it's a good point to talk about the support and resistance levels. Let's talk about support level. Imagine a floor beneath which the market struggles to fall. These are points where selling pressure begins to wane and buying interest starts to increase. Prices tend to stop falling at these levels and often bounce back up, indicating a potential reversal or pause in the downtrend. As traders, identifying these levels helps us recognize potential entry points or area to place protective stop loss orders, and it's about understanding where the market might find a base or a pause. And for example, you see here as a support level, this long downside shadow here just confirms for us that this is a key level for euro sellers and euro buyers. So it means we have a intense level of demand in the market that we usually stop that can usually stop the further fall in the price movement. But on the other side, we have a resistance levels, and think of this as a ceiling that the market finds hard break, like this level here, for example. And you see, let's say what has happened here. And these are points like this one, or this one, where buying pressure starts to diminish and selling interest picks up, often causing prices to fall back down after reaching these levels. And resistance levels signify areas where the market sentiment may be shifting from bullish to bearish. And for traders, these levels are crucial for identifying potential exit points or for placing short positions. Usually, there are two ways to trade on these levels that we will get to them shortly. However, understanding support and resistance is about reading the market's behavioral patterns. It's about recognizing where the market might take a breath, either to gather strength, to continue its trend, or to reverse its course. So it's these levels that often act as key decision points for traders, offering insights into potential future price movement. So let's delve a bit deeper and see how we can spot these key levels. Let's begin with historical analysis. Actually, this is where the art of technical analysis blends with a bit of market psychology. The past can often be a prologue into markets. By analyzing historical price data, we can identify points where the market is repeatedly turned around or paused. As an example here, you see uh, this is a very live example of that. These levels become significant because market participants remember them. We have had the first try here, the second try here, the third try here, and this is the fourth try to just break this significant level down. So they become self-fulfilling prophecies. Traders and investors alike look to these historical levels as a benchmark for making future decisions, which can lead to a reinforcement of these levels. And we will explore techniques to scrutinize past price movements and trends to pinpoint these key levels, helping us predict where the market might find support or resistance in the future. For example, based on the past a reading of the market, we see this is a key support level here, and we can expect the price to bounce back in the case that buyers go to defend this level. However, if we see any sign of the breaking this level to the downside, that would be a sell signal for us to jump onto market. By the way, this is a key level. So the first step to have a successful trade is to understand the key level and to identify or spot them on the charts. So right now you see this is a real life example. And now let's turn to psychological level. The best example for that is gold, because we know the gold with the very, let's say, speculation around the price levels. And we all know that, for example, anyhow, I can just define the 2000 as the important price level for gold. This is another example. So the markets, after all, are a reflection of human psychology. Don't forget that, guys. Certain price levels have a psychological significance that can influence trading behavior. And round numbers, for example, you see here 2000, are easy to remember and are often used as reference points for placing orders. They become psychological barriers, with prices often stalling or reversing at these points. For example, you see here after breaking the 2000 level in the mid of May, you see the price right to just bounce back to this level a couple of times. This point, and also this point, and finally it could break it above in the late of last month in November. 27th of November, we see this breakout to the upside, and after that we see this crazy move to the upside to reach the new high, new market top. So because we don't have this psychological barrier anymore, the 2000 against the price, so we see this very sharp upside jump actually in the price. So now we can combine historical analysis with an understanding of market psychology to identify the most likely support and resistance level. It's not just about drawing lines on a chart, it's about understanding why these lines matter. By mastering this skill, you will be able to better anticipate market movements. For example, we can go to another example as well. Let's back to Euro USD. You see, this is a key level for Euro USD right here, but right now to pin the very important key levels into the market as a support and resistance levels, the first step is identifying the market tops, the major tops and major bottoms. So somehow you can see they are almost near to the round numbers, for example, 1.127 somehow, but there are also psychological levels. For example, do you know what is the psychological level for a Euro USD on daily chart? This is the 1.10. It's a very important level, and also 1.85 is another psychological level for many traders. Maybe breaking this level to the downside can can be a clear signal, selling signal for Euro USD, or the let's say speak of the key levels. We can have the USD JPY as another example for now. For example, 151 is a very significant psychological level for USD JPY, as we had, for example, this historical level 145, for example. We can name it as a important historical level that you see the price is heading toward this level again after falling or retreating from the 151. So you can go through a different currency pairs and try to identify the key levels in terms of the psychological levels or the historical levels. So we know historical levels as the level that market usually reacted to them in the past. For example, something like this level in USD CAD, you can see we have a zone of intense supply and demand every time that the market gets to gets to this point, there is a it's usually acts as a barrier against the price somehow, but a strong momentum in the market, one of the confirmation signs that we can get is breaking a key level. So breaking this key level just confirmed a strong bearish momentum in the market that resulted in this downward movement or price fall to this level 1.348. So I suggest, guys, can be a very useful practice for all of you to just go through a different charts and try to identify the key levels. Okay, now we dive deeper into the nuanced world of support and resistance levels. It's important to recognize that not all of these levels are created equal, and understanding their different forms can significantly enhance our trading strategy. Let's discuss historical and psychological level, as we said, as one type of that, but we also have the static and dynamic levels. Static support and resistance levels remain constant over time. They don't change unless a significant market event redefines them. These are the levels you can draw on your charts and watch over periods. However, on the other side, dynamic levels evolve with the market. They are not fixed at a single price point. Moving averages are a common example of dynamic levels. As the market moves, these averages are just creating new support and resistance levels that are in sync with the current market condition. Uh, for example, here you see we have these levels. This is a fixed price level. As you see, but if I apply moving average on my chart, it's a 100 period moving average. You see, this is, we call it a dynamic support and resistance level. And the rule of thumb is that the moving averages are dynamic support when we are in an uptrend, and they can become a dynamic resistance as well when we are in a downtrend. So you see, it's not a fixed level of price, but this is the line, the calculated average of the previous 100 candlesticks that usually acts as a barrier against the price. And you see, a reliable moving average is the one that can react against the price. Every time that the price hits this level, we see a rejection from the sellers in the market. It means we have the intense, let's say, level of demand at these points here. The thing is that we call it a dynamic key level. There's a resistance level, and here you see it, we can identify this as a dynamic support level for the price. And breaking this level is also a significant sign of price of trend changes, or we call it reversal. As you see here, for example, this the significant downward movements here resulted in a break of two key levels. First, this static level of around 1.36, and also crossing below the 100 moving average. And this is a very clear sign of reversal in the market. And along with this, we see the market stopped making higher tops and higher bottoms. So this is another significant, let's say, confirmation that we can get from the price, mm, confirming that the trend is changing the direction right now. You see, we had higher tops and higher bottoms till we get to this point, and after that the market momentum just decreased, and then uh, uh, intense in let's say the accelerating negative momentum resulted in the breaking down of these levels, the this dynamic moving average and also this static support level, and it means the price changed the direction, and right now we consider it as the downtrend. So this is one way to combine the different price movements. So these are the levels you can draw on your charts and watch over periods. Dynamic levels, however, evolve with the market. They are not fixed at a single price point. Cool? Okay, so right here, let's use a practical application for our knowledge of support and resistance levels and how to effectively trade using these key markers. This is where we convert our analytical insight into actionable trading strategies. Let's start with entry and exit points. Uh, One of the most fundamental uses of support and resistance levels in trading is to identify potential entry and exit points. When the price approaches a support level, it can often be a signal for a potential entry point, especially if we anticipate the market to rebound upwards. Conversely, resistance levels can indicate potential exit points or short selling opportunities, particularly if the market shows signs of reversing downwards. The key here is to look for confirmation signals, such as price patterns or indicators that support your decision. And it's not just about the level itself, but how the market behaves when it reaches these levels. And the next use of support and resistance levels is risk management. This is crucial in any trading strategy, but particularly when trading with support and resistance levels. One effective method is to set stop loss orders just below or above these levels. Let's go through an example to make it more clear. For example, let's back to the USD CAD daily chart. You see, we have uh, a reversal pattern here as we see the market just had stopped making higher tops and higher bottoms. So we have the breakdown of these key levels here and now. We are in a downtrend. Let's say we want to trade this setup somehow. The first step is to identify a key level. For example, I can identify this moving average here, and I can think of going to a short position or sell the market if the price just rebound to this level to test this broken dynamic support level. Okay, so I can set, for example, using the pending order, I can set a sell limit, and I can just spot this level as my entry if I am sure somehow about the market rebound to this level, and then I can have a position here. This is the one way to trade using the key levels. Another one is to be a bit ahead of the market somehow. For example, right here, the thing is, we see the gold in a 1 hour time frame after this retreating from the top of $2,144. I can set a price level around here. You see, I have the moving average 100 linear moving average, and also the market bottom around the $2,056. So I can anticipate a downward movement when I see the RSI is in selling zone, and also the MACD bars are shrinking in a positive toward the positive zone towards zero. So I can anticipate the accelerating downside momentum if we see a break below this key level that can result in a breakdown of this static level and also this moving average. So in that case, I can open a sell position below this level, this moving average, and the another key level I can identify is this market top around the 2077. So I can just think of it as my stop loss level here. So this is another way that we can use to find the entry and exit points, and also to find a place to spot the stop loss levels. Very good. Okay, guys, we're running out of time. That's great. If you have any question, I see some questions have come, so let me just get to them. Yes. If you have any question, please write down your questions. I would be happy to answer them. Okay, here is a question asking about the the steps. What are the steps to trade the key levels, right? Like support and resistance levels, from Mr. Mohammed. Okay, thank you, Mr. Mohammed, for your question. Firstly, let's focus on trend identification. Drawing a trend line might seem simple, as connecting higher highs or lows. We will explain it in our next webinar for sure, but usually when we identify, first we need to identify the trend, and then we need to identify the key levels like market tops and market bottoms, and after that we need to spot a good entry or exit levels. The entry level is the level if you anticipate the market go in the same direction as the prior trend, so you can just go with the trend. And in that case, if you are in an uptrend, you can expect breaking of each resistance level to make a new higher high. So in that case, you can consider the breakout strategies, breaking each market top as a resistance level means the market is going to make a higher high, so the uptrend keeps going on. Okay, but if you are in a downtrend, you can just think it about the market support levels. For example, The breaking each supports level means the market is going to make a new lower low, so that means the downtrend will keep going on. So that case, you can just go to enter the market when you get confirmed entry point when you see a breakdown below a significant key support level in the market. So this is a main, let's say, strategy to enter the market using the key levels. I hope I could answer your question. Very well. Perfect, guys. Thank you so much for keeping along with this webinar till now. I wish you a great evening. I hope you join us in our next week's webinar. Thank you so much and have a great evening.